welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thanks for joining us on our Friday Insights edition today. Today we're going to go a little bit deeper into the Federal Reserve's two-day meeting in Jackson Hole. Ultimately, their symposium. It's basically all the Fed governors and presidents get together and they discuss the year in the past and the year in review, and more importantly, sort of policies and what they're thinking for the year to come. And right out of the gate, there was no surprises. The chairman of the Federal Reserve, Jerome Powell, was very hawkish, as we thought. In fact, earlier this week, I was quoted in Barron's and Bloomberg and a few other media outlets regarding waiting till Friday, and today's the day. Markets are moving. Markets are down 400 and 500 points in that neighborhood right now, and they're accelerating. So when the Federal Reserve chairman spoke earlier today, he basically was very hawkish. Again, not surprising. But it is market moving, and that's why we're actually bringing it to the forefront, to the attention, what we're paying attention to and how we're navigating. It's not a surprise, as we said. We position portfolios and cash accordingly. We'll take advantage of opportunities. But we also want to make certain that our clients understand the link between and the importance between these meetings and what moves markets. And you're seeing that empirically play out right now as we speak. So we'll see how we close today, but markets gap down and they continue to decelerate to the downside, or accelerate to the downside as we're filming. Now, we also had a investment committee meeting. Stephanie Link, our chief strategist for HighTower, basically gave her analysis this morning to our group. And let me just read you her quote right now. "We finally are done with the Jackson Hole obsession." Stephanie, you're exactly right about that in terms of the word obsession, because it's been like this for weeks now. That said, she says, "I can honestly say I have never heard a Fed chairman say," and I quote, "there will be pain for households and businesses." And that's exactly what he said in the middle of his speech this morning, as they fight inflation. Not much surprise here, but the hawkish in the goal indeed will be getting inflation back down to 2%. And the core PCE today was 4.5%. The PCE is exactly the number that the gauge, economic gauge, that the Federal Reserve actually pays attention to, and it's still too hot, right? Inflation's way too hot. That being said, keeping rates higher until inflation comes down. Think higher rates for longer, which then impact historically. It's not as, the higher rates right now that we're talking about historically are lower relative to what we've seen in terms of rates in the early 2000s, going back to the 90s, even the 80s, obviously early 80s, right? So we could absorb that. Corporate America can absorb that. But it's also going to have a historical impact on the long-dated assets. Think growth, technology, big tech, okay? We own that. We've owned that for quite some time. And a lot of that has been up double digits for 5 or 6 years in a row. So to give it back a little bit this year, yes, it doesn't feel good. But in all, are we selling it? No. A lot of those companies are running everything that we do in this, on a day-to-day basis, and they're going to be there for a good long time. They just have to get through this economic recession, if you will. And they're not... they're not insulated from the macro environments like interest rates changing. So they're going to have to adapt and change and moderate. But there's also other companies, other sectors of the balance sheets that are going to do better. So the lower down of what we call the capitalization structure. So the mid-cap companies and the smaller cap companies we're going to start adding exposure to. That's going to do well as the large caps just chug along here. It's not going to be outperformance, but it's going to be, making certain that they can manage through here. So that being said, this morning also, I was up bright and early and got quoted in this morning's Barron's. And here's my quote: "Because we don't know how high the Federal Reserve plans to rate or hike interest rates, we should be prepared for more volatility." And what do you know? We got more volatility this morning. And I just said, we're preparing our clients and our portfolios as a result. Now, let's go back to history, because Federal Reserve Chairman talked about that this morning. So Jerome Powell basically said he hearkened from Paul Volcker. He gave a quote and said, Volcker basically had to have a heavy hand to break the back of inflation based upon the missteps of the Federal Reserve in the 70s. So they didn't do as much as they had to do when they wanted to. So they took the medicine, and Paul Volcker, the Federal Reserve Chairman back in the early 80s, really was the one with putting the course of the economic 3-decade boom on its course. So we go through some pain right now, is what the Federal Reserve's talking about, but then there's expansionary times. Oftentimes, it's double digits. So you got to go through this to get to the other side. That being said, he also talked about Alan Greenspan. So it's almost like he's taking the Fed Avengers and assembling them. And it sounds like he, being the chairman, is really trying to give the, hey, listen, this is the line in the sand speech. I want the markets to know that we're serious once and for all. No more talking about it. We know that 75 basis points is probably already baked in and expected by the markets. The question is, for September's Federal Reserve meeting, the question is beyond that. Do we see maybe a 50 or a 75 between now and year end? But think about this. Here's how we see it, and this is what the economic truth. When rates rise, it takes 6 to 8 to 12 months to actually work its way into the economy. We're seeing the stock and bond market earlier this year slow down. Crypto market, right? $3 trillion to $1 trillion. That's $2 trillion out of the economy. Whether we believe it or not, it's trillions of dollars out of the economy. Federal Reserve wanted to go after that and pop that bubble, and they did. And now we're square in the middle of real estate. And that's happening right now. So does the Fed tighten, as I said before? They go until something breaks? Yes, that's what's going to happen. And he reiterated that today. So what are we going to pay attention to? What's really most important at the end of the day? It's the earnings. Earnings reports for the second quarter of this year came out over 70% of the companies met or exceeded expectations, and they're actually earning and growing as even the economy is shrinking. So corporate America can make it happen. Stocks and equity markets rise ultimately because of earnings. And let me take this. Now I have a board here, and in you can't see this, but in our studio here at Blanke Schein Wealth Management, we keep all of these. I keep all these on the walls, and I pulled this down from this time last year. Actually, a little bit fast forward. This would be just after the third quarter. The third quarter earnings report of 2021. And why I saw that when I first walked in today, I said, you know what, let's just go with this because I think this is very important for everyone to sort of see, is back then the Fed's number one goal was full employment and inflation. Well, today I just circled it in red for everybody because that's flipped. He actually said, the Federal Reserve Chairman said that employment's going to get hit. So that's the extra bubble he's going after. He wants the supply and demand, the equilibrium, the balance to come back into play as it relates to a hot labor market. So he sees and he's predicting, and he's actually going to go until the labor market is not so hot anymore. So he's going to increase unemployment as a result, because that's going to temper in some inflation, especially for corporations, right? So we're not chasing too many employees. So therefore, there's a chase or demand in terms of for the employees that are out there. So the balance will be there because the wage inflation is really one that gets embedded. And that's the one that I think long term Federal Reserve's worrying about. So these two priorities now, a year later, are switched. And we're in the middle of the third quarter of 2022. And back then, we had 82% beating and 4% in line of the S&P 500 when they reported ultimately. So again, we're in the middle of the third quarter of 2022. We'll find out. We're not in the 80s right now in terms of beating expectations because corporations are in the middle of doing what? Managing expectations. So they're going to bring down estimates. They're going to lower the bar so they could come home and say, no different than all of our kids, and say, you know what, that was a really hard test. But when they finally show us the results of the test, oh, they did better than the expectations of what mom and dad had, right? Managing expectations. No different than corporate America. So that's what we expect. So we're getting closer to the end of the rate increases. I really believe that. We're seeing some signs of inflation rolling over. So we're getting closer to maybe the Fed breaking something. We could see lower lows in terms of the S&P and the NASDAQ for sure, or even a retest of what our lows earlier this year. But we get past October, the uncertainty, which is the November elections, early November. And historically speaking, if you look at the charts, the way the markets perform once we get to a mid-cycle sort of election cycle that we are, so the second midterms right now, historically this is where the market is to trend lower from the August, September, October. And once you get past that, on the other side, that historically speaking, the returns are excellent. They're off the charts. In fact, if you would like, I'll share that with you on a one-on-one basis. We can go through it, and I'll maybe in another future Friday Insights, I'll show you what history has shown and proven. So we're in the middle of it. Markets are reacting to what the Federal Reserve has basically reported from their 2-day symposium today in Jackson Hole, but it's not unexpected. It's not a surprise. It's something that we here, as we manage money professionally for clients, take into stride. And then we also position ourselves to take advantage of it. So that's our Friday Insights today. Thank you for listening. And if you like, forward this to a friend, like and subscribe. If there's somebody in your family that you'd like that could benefit from this, give us their email, give us a phone call. We'll put them on our list. Again, it's free and we're happy to do it. Take care. Bye-bye.